Hello everyone, this is me again, Michelle, and today we are going to talk about how the Bangko Sentral ng Pilipinas or the BSP uses interest rate as a tool for monetary control and the impact of interest rates on inflation and economic growth. Let's start with how the BSP uses interest rates. The BSP adjusts interest rates to influence the overall level of economic activity and maintain price stability. When the economy is growing too quickly and inflation is rising up, the BSP may increase interest rates to slow down spending and borrowing, which can help cool off inflationary pressures. On the other hand, when the economy is slowing down and inflation is low, the BSP may lower interest rates to stimulate spending and investment, thus boosting economic growth. Now, let's delve into the impact of interest rates on inflation and economic growth. Changes in interest rates can have significant effects on both inflation and economic activity. Now, let's discuss the impact of interest rates on economic growth. Changes in interest rates can affect consumer spending, business investment, and overall economic activity. First, let's talk about inflation. When the BSP raises interest rates, it becomes more expensive to borrow money, leading to lower spending and investment. This slowdown in economic activity can help reduce inflationary pressures by curbing demand for goods and services. Conversely, when the BSP lowers interest rates, borrowing becomes cheaper, encouraging consumers and businesses to spend and invest more. This increased demand can lead to high inflation if it outpaces the economy's ability to produce goods and services. When the BSP raises interest rates, borrowing becomes more expensive, which can discourage consumer spending and business investment. This slowdown in economic activity can lead to lower GDP growth. Conversely, when the BSP lowers interest rates, borrowing becomes cheaper, encouraging consumers and businesses to spend and invest more, thus stimulating economic growth. Now, we are going to explore how open market operations influence the money supply and provide examples how these operations are conducted in the Philippines. Let's start with what open market operations are. Open market operations refer to the buying and selling of government securities by the Bangko Sentral ng Pilipinas or the BSP in the financial markets. When the BSP buys government securities from banks and financial institutions, it injects money into the economy, increasing the money supply. Conversely, when the BSP sells government securities, it absorbs money from the economy, decreasing the money supply. Now, let's provide examples of how open market operations are conducted in the Philippines. One example of open market operations in the Philippines is when the BSP conducts a repurchase agreement or repo transaction. In a repo, the BSP buys government securities from banks with an agreement to sell them back at a later date, effectively injecting liquidity in the banking system. Another example is when the BSP conducts outright purchases or sales of government securities in the secondary market. In this case, the BSP directly buys or sells government securities to adjust the money supply. Now, we are going to talk about the concept of reserve requirements and how changes in reserve requirements affect banks and lending. Let's start with what reserve requirements are. Reserve requirements refer to the amount of funds that banks are required to hold in reserve, either as cash or as deposits with the central bank, such as Bangko Sentral ng Pilipinas or the BSP. These reserves act as a buffer to ensure that banks have enough liquidity to meet withdrawal demands from depositors and maintain stability in the financial system. Now, let's discuss how changes in reserve requirements affect banks and lending. When the BSP increases reserve requirements, banks are required to hold more funds in reserve, reducing the amount of money they can lend out. This decrease in lending capacity can lead to high interest rates as banks compete for a smaller pool of available funds. Conversely, when the BSP decreases reserve requirements, banks are required to hold fewer funds in reserve, increasing the amount of money they can lend out. This increase in lending capacity can lead to lower interest rates as banks have more funds available for lending. In summary, reserve requirements play a crucial role in regulating banks' lending capacity and the cost of borrowing. When the BSP adjusts these requirements, it directly impacts liquidity levels in the banking system, consequently affect inflationary pressures. Again, thank you so much for joining us today. See you to our next video. Take care and happy learning. Bye!